Today we are going to talk about different trading and investment strategies in crypto. It's very important to be able to identify the different strategies because they all have different risk, return, and drawdown profiles. It's also important to be able to identify exactly what you're doing right now so you're able to properly frame your investment strategy. And in addition, knowing and understanding the different strategies might be able to help you switch and pivot into a strategy that better suits your needs.
R1, R2, R3.
Back with that buckaroos.
So at the bottom of the screen, you actually see a chart here saying if you bought $100 of crypto back on January 4th, 2013, it would be worth about $12,500. This is the Coinbase bundle. It's primarily a lot of Bitcoin with a smattering of a few altcoins. But the point here is this is one investment strategy. We're going to talk about the basic, buy and hold of crypto or the buy and hold of Bitcoin. It's worked really, really well in the past. But then again, if you just recently bought in December or January, it hasn't worked out too well for you. So let's jump right in and talk about the four main crypto strategies. Now, these are four distinct strategies, but many of us have a blend of the different strategies. In fact, I would argue most of us probably are utilizing all four to some extent, but it's important to recognize that they are four different strategies with different profiles, different risk return goals, different holdings, and different styles. So let's kind of go through these four different crypto strategies. First, you have just basic buy and hold Bitcoin. This is a strategy where you're utilizing fundamental or macro and determining that you want to hold Bitcoin above equities or other asset classes. And the example over time here is pretty straightforward. You're just holding Bitcoin all the time. What about the basic crypto portfolio, the buy and hold crypto? This is very much like my crypto quantamental CQF model. So you're long only a bunch of different coins and you're trying to beat the broad crypto market and Bitcoin. Again, here, the only reason why you would do that is you think the crypto market's going to beat equities and other asset classes as well. But here you think you can add a little bit extra on top. And the way you do this is primarily through fundamental and quantitative methods. And I didn't put macro here, but still you kind of think a little macro that you'd want to be in the crypto or Bitcoin space, generally. An example over time here is take an investor like myself, time zero, the start of the period, I own 15 coins, and over time, maybe I buy a few, sell a few, maybe my coins go down to 13 or 16, whatever it is, but I'm long only a set of coins over time trying to beat the crypto market. The third here, we have the directional tactical trader. Now, this is where they take a market position, net long or net short. This doesn't have to be in crypto, and this, frankly, is what you see a lot of Twitter and YouTube personalities do, like Tony Vase. He's just making a call on the market. Now, he's also a Bitcoin holder as well, but in terms of his YouTube and Twitter predictions, it's very much a directional trader. The methodologies you utilize here via technical analysis, fundamental, quantitative, your macro, as well. And here you can see the potential holdings and trades for a directional guy. For example, at the start of the period, perhaps they're 5% net long Bitcoin. Then the next month they go all cash. Maybe the next month after that, they're 10% net short via Ethereum. Then maybe the next month they're 20% short Bitcoin. And maybe the last month they're all cash again. So very much switching long and short directionally. Then you have the market neutral trader. Now here, they have zero directional bias. They're basically pairing long and shorts of equal risk. They utilize here technical, fundamental, quantitative. It's definitely not macro here because there's no market directional bet. So you can see here the 5 examples. The risk is the same. The amount is the same on both the long and the short side. So for example, the start of the period, 5% long Bitcoin, 5% short Ethereum, etc., etc., etc. And what they're trying to do here is capture the spread between the long and the short. Now, the beauty here is the market can tank, and as long as that spread works in their favor, they win. If the market moons, doesn't matter really either. If the spread is in their favor, they win as well. But like I mentioned before, a lot of us are a combination of these four. And on the right-hand side, we have the combination of a directional and a market neutral trader. So take the very first period example where the directional trader is 5% long Bitcoin and the market neutral trader is 5% long Bitcoin and 5% short Ethereum. With a combination of the two, if you just equally split them, you could be 10% long Bitcoin and 5% short Ethereum. So you're capturing the spread between Bitcoin and Ethereum, but you also have a market directional bias on the long side. So it can be a combination of all four. So what about the characteristics of these four main crypto strategies? So here we're going to kind of go up and down, a little bit to sideways at the same time. But first we're going to talk about Bitcoin, just holding Bitcoin. So what's the direction of Bitcoin, the holding strategy? You're simply long. What's your market net exposure? You're always a 100% long. And the exact same thing for the crypto portfolio, like the CQF model, you're long, always 100%. What about the tactical long short traders? They can be long, short, cash at the same time or at different times. So generally their exposure goes from a minus 100 to 100%. Usually it's a lot lower. Most traders only have a handful of percent in play at one time. Market neutral traders, they have long and shorts on at the exact same time, netting out to 0%. Now, going back to the tactical long-short trader, the key here is they all can have different risk levels. You can have a tactical long-short trader that's going all in at certain times, trying to put 100% on the line long, then going completely short later, or you can have guys that are just betting 1 or 2% at a time, and everything in between. Certainly, the better risk managers are on the smaller side, but the point is the risk can vary quite dramatically in that bucket. So what's your goal here? And this is where we begin to see the main differences and how to identify which strategy is right for you. So the asset allocation goal. So what are you trying to accomplish here? So with the Bitcoin long-term hold strategy, your goal is that Bitcoin beats equities. Straight up, from a total return standpoint and a Sharpe standpoint. Pretty straightforward. For the crypto portfolio, the CQF model type of strategy, the goal is kind of twofold here, is crypto beats Bitcoin because you're taking a bet away from the Bitcoin long-term hold strategy by holding altcoins. So you need crypto to beat Bitcoin, and then you need Bitcoin to beat equities to make that a good call. Again, on a total return and Sharpe basis. From a tactical trader standpoint, it's definitely a little bit different here. You're trying to beat a blend of equities and bonds from whatever you're sourcing from your allocation on a total return and Sharpe basis. Definitely here on very much on a Sharpe basis from a risk adjusted standpoint, because a tactical trader and a market neutral trader, they're very much uncorrelated alpha generating strategies that stand on their own, kind of isolated a little bit from your asset allocation. So it's very important that if you're a tactical trader making directional calls, that your bets end up increasing the total risk-adjusted return or your Sharpe ratio for your portfolio. The market neutral trader, very much the same as a tactical trader. You have to increase your Sharpe ratio from a portfolio standpoint, but you're generally only sourcing your market neutral trades from your bond allocation, because market neutral trades are generally lower risk, so you can take that from your bonds. And from there, maybe the standard from a total return standpoint isn't as high because your volatility of a market neutral trader is much lower. And then here I also have a strategy goal. For most of these, it doesn't really exist. The broader goal takes into account everything. But from the crypto portfolio standpoint, there's another point of potential alpha add here and a goal, which is that the coins you pick within crypto beats the crypto market. So this is exactly what the CQF model is trying to do. It's trying to, one, capture the crypto market that should hopefully beat Bitcoin and equities, and then two, via the model itself, is trying to pick better coins than the crypto universe broadly. So you're trying to gain alpha and additional excess return in multiple ways. So the next line here is the correlation with Bitcoin. This is absolutely critical, probably the most important line here, where the Bitcoin strategy is obviously perfectly 100% correlated with Bitcoin. The crypto portfolio, like the CQF model, is very highly correlated, but not perfectly correlated. The tactical trader is very low, but probably positive, and the market neutral trader is basically zero. So when you hear me say, Bitcoin long-term holders or crypto long-term holders, investors, they actually own crypto. This is why, because they're market exposed to crypto. They have high correlation to the market. Where tactical directional traders, it doesn't matter if your instrument is going long Bitcoin or going short corn or going long equities or whatever it is, your exposure to Bitcoin in crypto is very low, your correlation is very low. And the same with market neutral traders. By design, they have no market exposure, so they're totally uncorrelated to everything. So they're true uncorrelated alpha generating trading strategies that are pretty isolated from your asset allocation. Next line is, where do you see people typically implement these strategies? Take the Bitcoin strategy. You see people just, buy Bitcoin on Coinbase, put it in their cold wallet, or even leave it on the exchange and set it and forget it. That's one example. The crypto portfolio methodology, perhaps you could see stuff like Binance or KuCoin, etc. They have a lot of altcoins to choose from. And then the tactical and the market neutral trader, they need to be able to go short. So something like BitMEX would be appropriate for them. Here are some examples of people that you might be able to identify that do this. Would be Bitcoin maximalists for the long-term holders. Also very newbies to crypto, generally just buy Bitcoin. The crypto portfolio, like I mentioned before, the CQF model does that. And also perhaps a lot of people that are bag holders now, they bought high and they're just holding. But the reality is it's only a good idea if their bags are actually beating the crypto model, so the crypto universe and Bitcoin generally. And then just a lot of people just buying a lot of altcoins too. That would fit into this crypto portfolio bucket. Tactical traders, I mentioned tone earlier, but basically kind of pick your Twitter personality, YouTube personality, they fall here. You see a lot of charts out there, they're picking direction on coins and on Bitcoin or equities, whatever it is. They're directional traders making a long or short call. And a lot of retail, very new retail traders fall in this bucket as well. Then the market neutral category, there's actually very few people that do this by itself in crypto right now, because they're either taking a net long or net short position, or they have a long-term position, like just owning Bitcoin. They're not netting out positions. However, a lot of tactical guys are doing this kind of under the covers, where they are doing some pair trades, whether they actually realize it or not. And I think that's very important, that you recognize that you might be doing this without realizing you're doing it and understanding the nuances of the strategy. So what about performance expectations for different strategies? This is very important because it depends on your risk tolerance, your return expectations, how it fits in with your other assets, whether it's equities, bonds, 401k, or just your kind of human capital, depending on where you work. You want to make sure the strategy that you employ fits in well. And really the only person that can determine that is you and your financial advisor. But I can kind of give you an idea of what you should expect, the general profile for each of these different strategies to be. The Bitcoin hold strategy, the long-term Bitcoin strategy, has pretty high return potential, whereas the crypto portfolio actually has higher. So the crypto market should and is expected to outperform Bitcoin. The tactical trader generally take a little bit lower risk, therefore the return potential is actually lower than both Bitcoin and the crypto portfolio. But like I mentioned before, this is kind of how they gear it. They can actually go pretty darn crazy and have a ton of leverage, and that can kind of really blow out their risk to return. So here I'm just talking in terms of average. The market neutral trader, the average one, has very low return potential. They're almost just trying to beat bonds. Think of it that way. In terms of risk or volatility, Bitcoin has pretty high volatility. Owning crypto broadly has extremely high volatility. And a tactical trader, again, is kind of moderate to low, because most of them are only having a handful of percent at risk at a given time. And the market neutral trader is even lower. It's just basically the pair trades, the spread, and the volatility there should be pretty low. In terms of drawdown potential, Bitcoin and the crypto portfolio has massive drawdown potential. You've seen it over and over and over. So you have to keep that in mind. The tactical trader, Now here, it's important that they have kind of moderately high drawdown, but it's kind of uncorrelated. So if you have two tactical traders, I might do fantastic, and the guy next to me could lose it all. However, in terms of the crypto portfolio, the Bitcoin portfolio, if crypto does well, I have a crypto portfolio and the guy next to me has a crypto portfolio, we're both going to do pretty well. I might do a little bit better via my quantitative model, but he's still going to do pretty well. So there's less dispersion amongst different managers. And then with the market neutral portfolio, the drawdown here, again, is pretty minimal because the risk and return are pretty low. And the next one is pretty important, the investment manager risk. So what's the risk of the person that you entrust with making the investment decisions or giving you advice or giving you education, whatever the heck you want to call it? What's the risk within them? And a lot of times, 99% of the times, this is really yourself because you're making the calls. But what's the risk that you screw up or your investment manager screws up? And here with Bitcoin, there is no risk. So if I own Bitcoin, you own Bitcoin, and somebody else owns Bitcoin, no matter what happens to Bitcoin, you all get the exact same return. There's no difference there's no edge I have over you in that case. The crypto portfolio, there's certainly a chance for the investment manager to screw up. In my example before, say I have my CQF model trying to beat crypto. You have your collection of 10, 15 coins that you love. Well, the reality is we're both going to get very much the crypto market return. Just frankly, I hope I do a bit better. So there's some risk that you can pick a bunch of crappy altcoins and underperform. But by and large, you're anchored to the crypto market. The tactical trader here, this is 100% up to the manager. Like I said before, if I'm a tactical trader and you're a tactical trader and somebody else is a tactical trader, I could do fantastic. You could do mediocre, and the guy next to us could totally blow up and go bankrupt. So there's a lot of risk in terms of the individual strategy, the skill of the manager, the risk management of the manager, the full enchilada there. So there's a lot of risk on the person implementing the strategy itself. So you got to be very, very selective in who you talk to, where you put your money, what mutual funds you put your money with, or what you do with your 401k or whatever it is. In crypto, there's paid groups, all that stuff. You got to be very cautious because there's a lot riding on the investment manager or kind of who's making the calls and the strategies that they're using. It can go wrong pretty quick. Market neutral, again, the risk profile and the return profile is much more narrow. But again, you can have one guy long Bitcoin, short Ethereum, and then the guy next to you, long Ethereum, short Bitcoin. And they're both market neutral traders. So there's a huge difference between the two that can cause a massive dispersion in returns. And what about the investment manager ability to add extra return? The cherries, on top. Just the Bitcoin manager, again, none. If I own Bitcoin, you own Bitcoin, we're getting the exact same return. The crypto portfolio here, CQF model, it's enormous. So even though we are anchored to the crypto universe, so to speak, a good model like the CQF model, hopefully, should add quite a bit of return, on top of the market. So, and since the risk and return is so high, that additional extra return can also be very enormous as well. The tactical trader can add a ton of return as well, an uncorrelated return, so that's very good too. And the market neutral trader, they have a lot of edge they can potentially utilize and take advantage of. But since they're only trying to capture that spread between longs and shorts with no net market exposure, the return is actually, relatively, call it middle of the road. What's the main risk of these different strategies? So just buying Bitcoin, as you've seen over the last year, that Bitcoin loses to equities. That's your goal, and over the past year, that's failed, so it's a bad call to actually own Bitcoin over the past year. Over the past 4 or 5 years, it's been a tremendous call. The crypto portfolio, again, very similar. Crypto loses to equities. Again, over the past year, it's been a bad call. For the tactical trader and the market neutral trader, the chief risk, honestly, is that the investment manager, the mutual fund, the separate account, the cartoon character you're following on Twitter isn't very good, where they don't follow their strategy, where they forget about their strategy, or they fat finger something, or they just don't know what the heck they're doing, and they blow up. That's the chief risk. And then why do you want to use these different strategies? Like I mentioned before, the Bitcoin portfolio just because you think Bitcoin's going to be equities, the crypto portfolio because you think crypto is going to be equities, plus, this is very important, plus you think there's an ability that you have to outperform by picking better coins than the market. The tactical trader, it's because you found an A+ great trader and you want an uncorrelated high-risk alpha source. And the market neutral trader, very similar, except you want a lower risk approach. So how do you want to utilize these different strategies within your asset allocation? I'm actually pretty confident very few of you have actually thought about this, and this is very important from a risk management strategy, from thinking holistically with your entire net worth, with your entire asset base. So on the left-hand side here, you see the typical broad asset allocation, where it's 60% equities, 40% bonds, plus or minus some. It depends on your risk tolerance. On the right-hand side, you see generally what could happen if you utilize crypto in an asset allocation. Now, crypto or Bitcoin, from a long-only standpoint, is very, very high risk with a lot of drawdown potential. Therefore, you should be sourcing it from your equity allocation. You see here, equities went from 60% down to 55%, where I added the 5% of Bitcoin or crypto. And in order for this to be successful, you can easily see this here, since you took the money out of equities, well, your crypto or Bitcoin should be your equities from a total return standpoint, but also really from a Sharpe standpoint as well. And it's a little disclaimer down at the bottom that I'll mention right here. Don't use these weights as gospel. I'm just, talking in generalities here. The only person that can determine your asset allocation is you and your financial advisor. You've got to look at your risk profile, your age, your return expectations, everything. So everybody's a little bit different, but this is just a kind of broad brush and gives you an idea. What about a tactical directional trader, kind of long short guy? How does that fit in your asset allocation? So here, again, I'm putting in on the left-hand side 5% into this uncorrelated alpha generating tactical trader. But here, since they're so uncorrelated and they behave so differently, and the risk level can migrate from high to low, and it depends on the manager. So some of them might have really high risk, some might have lower. But generally, if they're middle of the road, you can actually source it from both equities and bonds. But remember, if you're really a high risk tactical trader, you should source it more from equities. But here you can see on the left-hand side, I sourced it from both. And on the right-hand side, I'm actually plugging in the directional trader with the 5% here. And again, in order for this bet, this allocation to this uncorrelated alpha generating trader to be a good one, it has to improve your risk-adjusted return for your entire portfolio. Now, secondarily, it should improve your total return from where you sourced it from, your equity bond mix, but really it comes down to your risk-adjusted return from a portfolio as a whole because it is an uncorrelated piece of the pie. What about a market neutral trader? Very similar to the directional, except here you can really source it totally from your bonds here because in general, market neutral traders are pretty low risk. Therefore, they're trying to beat the Barclays Aggregate Bond Index, something much lower risk with lower return. But again, in order to judge whether it's a good trade or a bad trade, and by trade, I'm talking allocation to this type of strategy, it has to improve your entire portfolio, including your equities and bonds and commodities and everything else, has to improve all that from a Sharpe standpoint. And a Sharpe is your risk-adjusted return. So basically taking into account total return and the volatility that you took to get that total return. So most of you, including myself actually, we're a combination of long crypto and these uncorrelated strategies. Now, we're all a little different, so again, it just depends. And some of this depends on your edge, so don't obviously take this as gospel or anything like that. But like, for example, myself, I am heavily weighted towards my CQF model, but I also make some directional calls, here and there, and I do, pairs and trades here and there as well. So I utilize all the strategies mentioned today, and I'm sure many of you do, but some of you might only use a couple. But how do you kind of put it all together? So here's an individual that starts with the 60-40. Just imagine you started getting into crypto and Bitcoin, and you have all these skills. Maybe you want to put a little bit in Bitcoin cold storage. Maybe you want to have something like the CQF model, and then perhaps you follow a cartoon character on some directional trades, whatever it is. So how do you kind of put it all together? And here, very similar, where the long-only Bitcoin crypto portfolio is sourced from equities because it needs to beat equities. It's higher risk. And the directional trades, the uncorrelated alpha trades, it's being sourced from a combination of equities and bonds. But what's really important here, and if I want to really close with this point here, is that the two strategies, the long-only crypto and the long-only Bitcoin, they're very different from a sourcing standpoint from the uncorrelated alpha-generating strategies of the directional traders and the market-neutral traders. They're distinct. So you've got to treat them very differently. Maybe you bucket them together, the two and the two, but what you don't want to do is necessarily group your long-term crypto with your directional trades. And that's what you see on the right, where I mentioned before, in this general asset allocation, 5% to the long-only crypto and the 5% to the uncorrelated strategies. But here you see where the 5% on the right got sourced from equities for the long-only Bitcoin, and then 5% also got carved up for the two uncorrelated strategies. So they're very, very different. And the key here is if you want if you want exposure to Bitcoin and crypto, and you think it's going to moon over time, and you think it's going to be a store of value or a third-rate currency or even a major currency or just something transactional, whatever it is, you think the price is going to go up and you want to bet on that, then you're making an asset allocation call into crypto at the expense of equities. By doing that, you have to recognize crypto has to be equities. Simple as that. If you're making directional calls, that you're not making a call on Bitcoin or crypto broadly. So whether crypto does really well and goes to the moon, whether it becomes a real currency, whether you can actually buy your coffee with it, all that is pretty immaterial. That's irrelevant. What matters is you have an uncorrelated alpha generating piece of a strategy that you're employing, and does that strategy add risk-adjusted returns to your portfolio over time. Whether crypto moons or not, you're not betting on that. Now, maybe under the covers you are, because you might be long Bitcoin in that directional strategy. But from an overall strategy standpoint, you're not making an asset allocation call into crypto or Bitcoin. And that's a very important distinction to make. And that wraps up this video on the 4 main different strategies that people employ in crypto, from trading and investments, and the fact that they all have different risk return drawdown profiles. A lot of us actually combine them, and how to source the different strategies from your overall portfolio. If this is beneficial, obviously please like this video. Follow me on Twitter and YouTube. Twitter at CryptoQF, YouTube Crypto Quantamental. It'd be great if you follow me, great if you comment, great if you retweet. Anything that you can do to help out would be fantastic. Just kind of everyone just keep their head on high and just keep doing what you're doing. And hopefully good fortune awaits all of us, no matter what strategy you guys pick. Good luck.